With geopolitical tensions hitting a fever pitch, the big question isn't if a crisis will happen, but how you prepare your money when it does. Today, we're going to break down the data-driven playbook for protecting your capital in this, well, pretty volatile world. Let's get right into the numbers. All right, first things first. If you've got this feeling that the world is more on edge than ever, well, you're not wrong. It's not just a feeling. Take a look at this chart from MSCI. It actually tracks geopolitical risk, and you can see, wow, the recent spikes are at multi-decade highs. This isn't just some scary headline. It's a real, measurable shift in the global landscape. And yeah, it has real consequences for your portfolio.
And that, of course, brings us to the most important question of all, right? When the world seems this chaotic, what's the smart move? What do you actually do with your money to defend what you've worked so hard to build?
Okay, so the first layer of defense. This is probably the most counterintuitive thing we're going to talk about. Seriously, it's not about what you do, but what you don't do. Think about it. When those alarm bells are ringing everywhere, your first instinct, your gut reaction, is to sell everything, right? Get to cash. But you know what? History shows us time and time again that this is almost always a huge, costly mistake. Markets, they react to fear, for sure, but they also recover. Let's look at a classic, almost unbelievable example. Okay, let's go back to the 1962 Cuban Missile Crisis. I mean, this was arguably the closest the world has ever come to actual nuclear war. In just 8 days, the S&P 500 dropped a terrifying 6.3%. This right here, this is the moment of absolute peak panic. But, and this is a huge but, look what happened next. For the people who held their nerve, who didn't panic sell, the market was up a staggering 36.7% just 5 months later. This just brilliantly illustrates the danger of reacting to headlines instead of sticking with your plan. RBC Dominion Securities really sums it up perfectly here. They say history has shown that staying invested and on track with your investment plan during these volatile times is very likely the best choice. So that's the first and most critical rule in your defensive playbook. Just stay the course. But hey, that's just the foundation. Now let's look at the active tools you can actually use. All right, so if rule 1 is don't panic, rule 2 is all about understanding the tools that are actually designed for these moments. I'm talking about safe haven assets. But which ones? Which ones really work when it counts? The data here might really surprise you. So just to make sure we're all on the same page, what even is a safe haven asset? Well, think of it like your financial shelter in a storm. It's where you put your money when you expect turbulence everywhere else. Simple enough? Now, let's grade how they actually perform. Okay, now this is where it gets really interesting. This data looks at 4 major geopolitical conflicts and tracks how these key assets performed. We've got gold, the US dollar index, that's the DXY, the US dollar versus the Swiss franc, and Bitcoin. Now check this out. Notice how Bitcoin has that initial pop in the first month, but then it's followed by a nearly 19% crash over 6 months. Whoa. Meanwhile, look at gold. It starts off kind of slow, but over a full year, it delivers a powerful 14.7% return. The big takeaway here is that your time horizon completely changes the story. Let's just isolate that long-term view, because honestly, that's what really matters for preserving wealth. Over 12 months, you've got this clear face-off. Gold proved to be the reliable hedge, the winner. And Bitcoin? Despite all the hype about it being digital gold, it ended up deep in the red. The numbers, they just don't lie. So what are the key lessons here? What do we take away from this? First, gold has absolutely earned its reputation, especially if you have a bit of patience. Second, the Swiss franc is remarkably consistent in these situations. Third, Bitcoin? Look, it's just way too volatile to be considered a reliable safe haven, at least for now. And finally, here's a big one. Don't just assume the US dollar is a guaranteed winner. Its performance is surprisingly mixed. All right, so staying the course and understanding safe havens, absolutely crucial. But the truly wealthy, they go several steps further. They don't just prepare for a storm, they literally build a fortress. And this is a really fundamental shift in mindset. It's not about trying to find one magic asset that's going to save you. It's about creating a truly resilient structure, one that's designed to withstand pretty much any shock, whether it's political or economic. So how do they do it? Well, this analysis from Forbes reveals the 5 pillars of a true financial fortress. First step, a liquidity stack. We're talking cash and short-term treasuries. The This is so important. It means you are never, ever forced to sell your long-term assets at a bad price just because you need cash. Second, jurisdictional diversification. This is about managing political risk by not keeping all your eggs in one government's basket. Third, a Plan B residency or a second passport. This gives you the ultimate optionality in freedom's movement. Fourth, they hold productive real assets. Think farmland, timber, things like that. These are assets that can't be devalued by just printing more money, and they often generate their own income. And finally, they use ironclad legal structures like trusts to make sure their assets are protected and can be transferred smoothly. See? It's about building a structure that can outlast any single crisis. Okay, so we've covered the psychology, the tools, and the fortress strategy. Let's pull this all together now into a clear, layered action plan you can actually think about. So here it is, your 3-layered defense. The foundation is all about discipline. You don't panic sell. The toolkit is about knowledge. You understand which assets, like gold, have historically worked well as a hedge. And the fortress? That's the long-term structure. That's when you start thinking like the wealthy, beyond just stocks and bonds, to things like liquidity, global diversification, and real productive assets. And that really leaves us with one final thought to chew on. I want you to take a hard, honest look at your own strategy. Is it built on the hope that things will just stay calm, or is it designed to be resilient in the world as it actually is? Because the answer to that question, well, it could make all the difference.